Let's begin our legal disclaimer. Please note that this presentation may contain comments that constitute forward-looking statements which involve risks and uncertainties. Examples of forward-looking statements include descriptions regarding the intent, belief, or current expectations of the company or its officers with respect to future results or business operations and financial condition, industry, environment, and future events and plans of the company. Such forward-looking statements are not guarantees of future results, performance, or achievements. Actual results, performance, or achievements of the company may differ from those expressed in the forward-looking statements as a result of various factors, such as known and unknown risks and uncertainties, and assumptions, including those risk factors discussed in the Trendlines offer document dated 16 November 2015, and in the company's filings on the SGXnet, which you are encouraged to review. By their nature, forward-looking statements involve risks and uncertainties because they relate to events and depend on circumstances that may or may not occur in the future. In light of these risks and uncertainties, actual events, results, and developments could differ materially from those expressed or implied by the forward-looking statements. The statements represent the company's or its officers' views only as of the date they are made and should not be relied upon as representing the company's or its officers' views as of any subsequent date. The company does not assume any obligation to update any forward-looking statements. Finally, please note all monetary values cited are in US dollars unless otherwise specified. These are the topics we'll be covering today. The slides for the half-year earnings presentation, as well as the financial results for the first half of 2022, are available on the investor page of the Trendlines website. I will now turn the presentation over to Todd Dollinger, Chair and CEO of the Trendlines Group.
Thanks, Shara. We're pleased to be here today to talk about our work and our mission, investing to improve the human condition. Both history and current events prove the critical importance of our mission and serve to strengthen our resolve in working with all toward the achievement of our mission. In January 2022, we announced an agreement with a group of current and new investors to invest a total of $20.27 million, approximately US 15 million, in 8 quarterly tranches at a 12 cents price per share, approximately $4.45 US for our ADS. The first 3 tranche payments have been received as scheduled. We recently announced the write-off of Stematics GI from our books. This, of course, is deeply disappointing. Today, though, our portfolio is stronger and more diversified than ever, with no portfolio company accounting for more than 10% of our total portfolio value. Our portfolio is more balanced and accordingly more risk mitigated relative to the impact of any single investment than ever before. Now, focusing on our portfolio companies, despite continued disruptions worldwide due to the COVID-19 pandemic, many of our companies reported business achievements in the first half of this year. These achievements reflect a higher level of portfolio company maturity than we've ever seen before, and this maturity level is reflected in the amount of follow-on capital that our companies have raised, in the average size of the raises, and in their valuations, and in the significant milestones being achieved, and ultimately we believe in both the size and frequency of exits that we will experience. As our portfolio is large, to understand the Trendlines opportunity for our shareholders, note the achievements of our maturing and mature companies that are ramping up significant milestones. It's the sum of these stories, these amazing stories, that constitute the value of the Trendlines Group. A significant number of our companies completed raises in this period, including some in much more substantial amounts, indicative of our maturing portfolio. During the first half of this year, 18 portfolio companies raised a total of over $20 million. Following last year's announcement by Vensica that it entered into a strategic license and collaboration agreement with the pharmaceutical company Merz Therapeutics for the delivery of Merz's generic Botox into the bladder wall using Vensica's innovative ultrasound-assisted delivery device. Vensica, a drug device company, completed a $19 million raise with the participation of Merck Therapeutics, Laborie, a fast-growing medical device company, and Trendlines. Phytolon, our company producing natural food colors via biological fermentation and sustainable processes, announced a $14.5 million raise led by food giant DMS's investment arm. Companies Setbone, Ecophage, Seritrieve, these are companies among others that closed fundraising in the first half of the year. Additionally, our agri-food funds portfolio company Equinome recently completed a $35 million raise at a substantial increase in value. Escala Medical announced FDA clearance, paving the way for entry into the US market for its non-surgical solution to pelvic organ prolapse. And Lamaca Medical received FDA breakthrough device designation for its precision endoscopic ultrasound biopsy device. Some 7 companies launched clinical or field trials despite pandemic-related logistical challenges. These trials advance our companies toward their regulatory and commercial goals. Clinical trial success moves our companies toward increased valuations, revenues, and potential exits.
I'd like to tell you a bit about some of our agri-food companies. Through our monthly updates in our newsletter, we publish information about companies that have achieved meaningful milestones. In the first half of the year, we have a number of portfolio companies with achievements of note. We want to give you just a sample of the progress made by looking at 4 outstanding agri-food companies from our portfolio that have made significant progress and represent the high caliber companies in our portfolio. All 4 have completed investment rounds to expand their capabilities, and all have strategic collaborations with multinational corporations already signed or in the offing. As Todd mentioned, recently Phytolon announced the completion of a $14.5 million A round, a remarkable achievement for such a young company. Phytolon has captured the attention of industry leaders as well as VC funding. In fact, the company has completed paid pilots with at least half a dozen of the leading food companies in the world. We look forward to Phytolon's progress going forward. FruitSpec, which is in the area of monitoring and providing information for growers in the fruit industry, reducing a loss, which today accounts for up to 10 to 15% of all fruit, raised $5 million last year from venture investors and has broadened its sales base and is making great strides in the food supply chain realm. In fact, the company's sales this year will probably increase by about 4 times compared to last year. Similarly, Bioefficiency in the aquaculture space has logged record first half sales and expects a record for the full year. And with its new patented technology, expects to see tremendous growth in sales in the coming years. The company unlocks the potential for new market segments such as salmon and shrimp, and has partnerships in process with at least half a dozen leading companies from Europe, Israel, the United States, and Asia. Another of our aquaculture companies, Viaqua, is poised to launch its first product next year and is expanding its pipeline by adding additional diseases and new species to its product mix, including products for barramundi in cooperation with a Singapore partner. The company also has investment and partnerships with Nutreco, one of the largest food companies in the world. These are just 4 companies, and they represent a small bite of our 26 agri-food companies. Todd, something about our healthcare companies?
Right. Turning back to the medtech business, we're going to focus right now on talking about just a few of our companies. Of these companies that you see here in the presentation, 3 of them have achieved regulatory clearance and have launched sales. Arcuro has FDA and CE clearance and has launched sales in the US and Latin America. The company is working with some of the most important key opinion leaders in sports medicine and is marketing its meniscus repair device as the clearly superior device for faster, easier surgeries. Arcuro has recently strengthened their team with the appointment of Dr. Phil Davidson as medical director and as chair of the company's scientific advisory board, joined by Dr. Ken Zaslav in New York, both leaders in the orthopedics field. In the same vein, ST Stent has FDA clearance and has started to sell to key accounts and opinion leaders in the US. As we often do, as ST Stent advanced with its nasal stent for post-surgical procedure recovery, we brought on board Mike Berman, former president of Boston Scientific Cardiology. We brought him into the company as its chair and commercial director. Mike's decades of experience as a top executive clearly increased the value of ST Stent. Liberty has launched a new clinical trial with very good results and aims to complete its regulatory process in the near future. Liberty allows for easy, safe home dialysis for the growing population of renal failure patients around the world. Escala Medical provides a non-surgical solution to pelvic organ prolapse, a critical problem for many women past childbearing. They've achieved FDA clearance this year and are currently fundraising in preparation for their launch in the US market. And last on our slide here, Seritrieve, developing a next generation catheter for ischemic stroke prevention, has completed a $2.5 million raise and performed successful life-saving cases in Israel and abroad as part of its clinical studies. Worth noting is that 3 of these 5 companies, Arcuro, Escala, and Seritrieve, have female CEOs, reflecting our commitment to diversity in Trendlines and our portfolio companies. They join another 5 female CEOs, a total of 8 within the Trendlines Group portfolio of companies. So let's take a quick look at the development and value in our portfolio. Over the past 15 years, our total portfolio value, including cumulative exit proceeds, has increased, reaching $130 million at the end of June. It's important to note that this does not include the value of 13 consolidated Singapore-based companies. At the end of the first half of this year, the fair value of Trendlines' portfolio was $81.1 million, as compared to $83 million at the end of last year, a 2.4% decrease in value. Since our IPO, our portfolio value has more than doubled. The write-off of Stematics, of course, adversely affected our portfolio value for the first half, but it needs to be noted, it really puts the portfolio in a much more balanced position moving forward. We expect continued growth and strong performance ahead. Now we're going to turn back to Steve Rhodes, co-chair and co-CEO of the Trendlines Group, to continue the conversation.
Thanks, Todd. I'm filling in today for our CFO, Chaim Brosh, who is on a well-earned vacation this week. Here's an overview of a few of our key financial metrics for the first 6 months of the year. Our portfolio value decreased slightly, as Todd mentioned, compared to December 2021, mainly due to the write-off of Stematics, as previously noted. Our total equity book value decreased by $8.3 million, and our NAV per share decreased to Singapore dollars 16 cents per share, a 60% premium over our share price at the end of trading as of yesterday. We reported a net loss for the first 6 months of $11.9 million compared to a $4.1 million gain over the same period last year. Looking at our balance sheet, cash and receivables were $12.8 million at the end of June. Receivables include the first 2 tranches of the proposed subscription agreement and the second milestone payment from the Epifix exit, which came due in April of this year. Our cash position continues to be solid, as reported at the end of 2021 and continuing at the end of June 2022. An increase of $3.2 million in the fair value of portfolio companies was partially offset by a decrease of approximately $2.3 million in the fair value of a variety of portfolio companies, while the write-off of Stematics, approximately $7.9 million, and another portfolio company at a value of $500,000 accounted for the rest of the decline in portfolio value. Contingent consideration receivable decreased to $4.9 million compared to $6.6 million at the end of 2021. This amount represents the present value of the estimated future earnout from the ApiFix sale and was adjusted downwards based on information derived from the acquirer's financial reports. Total shareholders' equity for the period, at the end of the period, was $94.8 million, compared to $96.3 million at the end of 2021, and 69% more than our market cap of $56.8 million at the close of trading yesterday. Turning to our P&L, total income for the first half of 2022 was a loss of $4.9 million compared to $11 million gain in the first half of 2021. As we've always said, a profit and loss for our company will always be lumpy, given the nature of the way we report, looking at up and down valuations of portfolio companies. What we need to follow over time is the upward trend of portfolio value. The decrease this first half was mainly due to the decrease in fair value of Trendlines portfolio companies, primarily from the Stematics write-off. Income from services to portfolio companies increased to approximately $1.3 million compared to $756,000 in the first half of 2021. This is mainly revenue recognition for services we provide to our Israeli portfolio companies during their first 2 years of incubation. Income from contracted R&D services remained relatively unchanged, with the outlook for the second half of the year quite positive. Turning to the expenses on our P&L, operating, general, and administrative expenses increased by approximately $200,000 during the half. This increase is attributable to expenses related to 2021 events that were only recognized for financial reporting purposes in 2022. We expect a decline in G&A expenses during the second half of 2022. Net R&D expenses increased by approximately $400,000. This increase was mainly due to increased R&D expenses of consolidated subsidiaries. Financial expenses also increased by approximately $1.3 million, primarily due to the write-down of the ApiFix contingent receivable. As already noted, we had a net loss of $11.9 million compared to a net gain of $4.1 million in the first half of 2021. The pandemic has highlighted the importance of our mission, investing to improve the human condition. And now more than ever, our health and our food are clearly essential systems in which the world must invest to ensure well-being and quality of life for all. We see the importance of this with the constant flow of potential investors and strategic partners who visit us and speak with us to look at our high-value portfolio companies. These companies address the needs of the world. The needs are urgent today and will continue to be urgent tomorrow. We are fully committed to our investment focus on the health and food sectors to significantly impact lives while building value for all our stakeholders.
Thank you, Todd and Steve. To remind our listeners to submit a question, use the question and answer function in the conference call, or alternatively, send them by WhatsApp. We will now answer a few questions that we've already received. Okay. One of the questions is, what were the lessons that we learned from the Stematics experience?
Stematic is really a fascinating journey for us. It was a company that was created both because of what we saw as tremendous financial opportunity and very, very much in service to our mission of improving the human condition. We went into this investment with great excitement. And when we sold the company, we sold it to B. Brown, the fourth largest player in the stoma field and the largest of all of the companies in that field. And we did so putting the company in the hands of a trusted company, and with the great hope that they would really bring it forward in a major way to help people and to profit all, including for us, as we expected to receive substantial royalties in the future. Unfortunately, they did not perform on the marketing side, and that leaves us directly to the question, it leaves us using the greatest of care in our negotiations on potential acquisitions as it relates to earnouts. I think this is well known in the industry that when you're dealing with earnouts as part of your compensation, there are many risks attached. And when that deal was made many years ago, we understood that there were risks attached. We had the right expectations at the time, but unfortunately, as can happen, those expectations were not achieved through the lack of performance of our partner. This leads us to be far more critical in entering into such agreements for the future.
Okay, we have another question which refers to our portfolio value and how it's calculated. On page 23 of the results, why are the 30 consolidated Singapore-based companies and the 3 Trendlines agri-food fund companies excluded from the fair value of portfolio companies? Steve, would you like to comment on that?
Sure. Thank you for the question. The accounting rules say that we can non-consolidate or report a fair value of portfolio company if we don't control it. And control is defined by the accounting rules relates to the amount of equity that we hold in the companies. In the case of the 13 Singapore-based medical companies, we have very significant shares in all of those companies, well over 50%. Because we have over 50% in each of those companies, from the perspective of the accounting rules, we're considered the controlling shareholder, and as such, we're required to consolidate those companies. In the future, as those companies succeed in raising capital at increasing amounts and our share is diluted in the companies, we do expect them to become deconsolidated and start reporting them at fair value. And at which point they will, we'll see probably a big jump in our books from those companies, from nothing basically to having whatever value is generated from the raise. Regarding the 3 Trendlines agri-food fund companies, these are young startups based in Singapore that have received investments from our agri-food fund. Our agri-food fund holds nice shares in each of these companies, but we don't report the holdings of the fund since those holdings flow through to the LPs in the fund, and our share, our profit from those companies is simply our carried interest. We do have very small stakes in each of those companies that we hold directly by virtue of providing incubation services to them in Singapore, but the value of those small holdings at the moment is insignificant. It's not material, and so we don't report it out in our fair value at the moment.
Just to quickly add to what Steve has shared with all of us, the consolidated companies, of course, in real life do have real value, but accounting rules don't allow us to show that on our books. In Singapore, on the medical side, 3 or 4 of these companies will actually raise outside capital this year. The 3 of those deals are far in process, and we hope to close them within the next 30 to 60 days. Interestingly, again, in accordance with Steve's discussion, these companies still will not be brought onto our books. They will not be deconsolidated because we will still own very large positions in these companies. So we think of these, we speak internally of these companies and also the work of our Trendlines Labs group as hidden value. It does not show up on our balance sheet. Our projections from royalty income on the Trendlines Labs work does not show up on our balance sheet. So it very much fits in a class of hidden value.
Okay, thank you very much. Next question. From the recent SGM, is the aim to have 11 members in the board of directors? Billion-dollar market caps like Keppel and DBS both have 11 board members. Fellow Israeli company Serene has a market cap of 160 million, but only has 7 board members. What's the reasoning of having 11 board members?
I have 2 answers that I want to share here. First of all, our controlling shareholder, Vincent Chengiz, who has been a magnificent supporter of the Trendlines Group, and upon completion of the financing that's in process, will own 29% of the Trendlines Group and has invested in many of our portfolio companies and venture funds. He requested to have representation on the board. This was after a long time without him having considered that. And when he came to us and made that request, our response was, we'd be happy to have you appoint 2 members to our board. To appoint 2 members to the board, requires to maintain independence for the board, the appointment of 2 additional members, a total of 4 members. So there we go from 7 to 11. Is it a large board? Absolutely. But we're proud of the fact that we've made great use of our board. We have board members today in Israel and in Singapore. And with the additional board members, we will add a board member in the US, board members in the UK. We will increase the representation of women on our board. We expect, as the board grows, to have at least 4 women on our board. So we're growing internationally. We're growing in terms of appropriateness of gender balance on our board. And we're proud of that. And we feel that we will make good use of these board members. They've been strong contributors for us, and the people that will be joining the board, we know will be strong contributors in the future.
No, I would just add to that, while a 11-member board is large, and I think we would probably prefer to have a smaller board, we think it is manageable, particularly if we bring in high-quality members of the board. As Todd mentioned, our directors and the new directors that we're talking to have been very supportive and also very helpful in terms of making introductions for the company, providing strategic insights and direction. And so we do get a lot from our directors. We're talking to very high-quality people about joining the board. And in fact, we'll be coming out with an announcement quite soon, I think, about a new addition to the board, which of someone of very, very high quality, which I think will, someone who will be recognized by many people in Singapore.
Okay, thank you. A question about VC funding and the ecosystem. A lot of VC funding activity seems to have slowed either in number of deals done or at lower valuations. On the contrary, on Trendlines results, page 26, it writes, "We have not yet identified a notable decline in fundraising activities." Can the management please provide more detail regarding this point?
You know, as we...
I'm sorry, first of all, we have to start out by thanking Bob for reading everything so carefully.
As we pointed out during the presentation, during the first half of the year, we raised a total of over $20 million for a large number of companies. And actually, if we add in the Equinome raise, which happened after the end of the first half, it's $55 million. So we've had some nice raises. The Phytalon raise was an A round that included not only DSM, but also ADM Cibus from Europe and Ginkgo Bioworks from the United States. So we do see activity and investment. And as we said, we have not yet identified a notable decline. That doesn't mean we won't see one in the months ahead. Raising capital is always difficult, even in the best of times. Young companies always have a hard time. VCs often tell us this company is really interesting and we like it, but it's too early for us to invest. So the challenges are always there. At the same time, many investors understand the value of investing in young companies that are private companies now when the stock markets are not doing well, with the idea that they're investing so that as the companies grow and as we come out of this business cycle, they will benefit from the increase in value of the companies. So we're cautiously optimistic, although it could be difficult to raise capital.
I think Steve's caution here is very important, that we'll see what happens. Right now, we're doing well, but the past suggests to us that this will be a good period. During downturns, we tend to do well with raising capital for our youngest companies in particular. We've had lots of conversations with investors about this. And part of the reason that's been shared with us by many is that we see an appetite for taking money out of the public markets and moving into privates. This advantages us because all of our portfolio today is private. Additionally, as you hear when we talk about our raises, while occasionally we're talking about raises that are $15 million or $20 million, for the most part, our raises are smaller, $3 million, $5 million, although increasing. And in the smaller rounds, we find that there is not real pressure on the valuations, unlike what we're seeing today in the markets on billion-dollar cap companies being slaughtered. These younger companies at lower valuations, historically for Trendlines, and seemingly in this year as well, we perform decently during these times on our raises. but the caution that Steve shared should be remembered by all.
Okay, thank you very much. We have no more questions from the audience, so I'd like to thank everyone for coming in and listening and participating. We always welcome questions and clarifications, which can be sent to me at shira@trendlines.com. We thank you for that.
Thanks,
Bye-bye.
everyone.